RC. And this question asks us to prepare extracts from RC's income statement and statement of financial position in respect to some movements in property, plant and equipment and government grants for year ended the 31st of March X7. Firstly, let's look at property, plant and equipment. And in the question we're told that the opening balances of property, plant and equipment on the 1st of April 20X6 are 240 in cost, accumulated depreciation of $180 million, and of course a carrying amount of $60 million. Now the first thing we're told is about a disposal, and in relation to this disposal we're told that we had purchased a piece of equipment which on the 1st of April 20X3, which of course is 3 years previously, had cost 90. We had calculated its accumulated depreciation to the 1st of April 20X6. Now again, we purchased it at 90, its residual value is 10. We're depreciating it over 4 years, and of course 3 years have elapsed. So consequently, our accumulated depreciation is 60, giving us a net carrying amount at the date of disposal on the 1st of April X6 of $30,000. Now again, it's important to note that the 1st of April X6 is actually the first date of the year where we're presenting financial information. So here we see the disposal entered into our property, plant and equipment schedule. Next, we're told in note 2 of the question that we acquired some property, plant and equipment on the 1st of July 20X6. Now we're told the base cost of the property, plant and equipment is $192,000, but we're also told about additional costs in relation to modification at $12,000 and transport and installation at $6,000. Now we know from IAS 16 that all of those costs can be capitalized, so consequently we recognize the total of $210,000 at acquisition. And of course this piece of plant was acquired on the 1st of July X6. Now the 1st of July X6 is 3 months into the year, so there's 9 months of depreciation to be charged. The useful economic life is 3 years, so again we calculate the depreciation with respect to the cost of the piece of property, plant and equipment of $210,000. So the depreciation relevant to the acquired piece of equipment is $52,500, leaving us with a carrying amount in relation to the acquired piece of equipment of $157,500. Now of course there's other depreciation. We have total assets of total property, plant and equipment of $240,000. We've disposed of 90, but of course the remaining property, plant and equipment has to be depreciated. And again we're told in note 3 that all other plant is depreciated at 15% per annum on reducing cost. So the depreciation in relation to other depreciation, other property, plant and equipment is $22,500, reducing the carrying amount by $22,500. So therefore in our property, plant and equipment account carried forward at the 31st of March X7 we have $165,000. Next, let's look at the situation with government grants. Again, in the question we're told that brought forward on the 1st of April 20X6, which is the first day of the year, in non-current liabilities we have government grants of 30, and in current liabilities we have government grants of $10,000 respectively. Now firstly, because we disposed of a piece of equipment before the government grant had been fully realized, in note 1 we're told that in relation to the disposal, and we're given the number, RC had to repay $3,000 of the grant at the disposal of the related plant. So therefore our updated figures with regard to the 1st of April 20X6 reduce the amount in current liabilities from 10 by 3 to 7. Now in the year to the 31st of March 20X7, which is the year which we are interested in, those current liabilities will be reduced to 0 and will be recognized as in the income statement as income from government grants. So again you can see there our current liabilities being reduced by 7 and again the income statement income being recognized. Now we're also told in the question that in note 4 of the question that 11,000 of the 30,000 non-current liability for government grants at the 1st of April 20x6 should be reclassified as a current liability as at the 31st of March x7. So here we can remove that 11,000 now in relation to the reclassification from non-current liabilities and reclassify it as a current liability. Now, in terms of the grant that's receivable, so again in relation to the piece of equipment that we bought on the 1st of July 20x6, we're told that there's a grant receivable on this and that this plant qualified for a government grant of 25% of the base cost of the plant. So let's look at a working on that grant that's receivable. So the total grant receivable is 25% of the base cost of the plant. And of course the base cost of the plant is $192,000. So the grant that's receivable is $48,000. Now, to the income statement in the year, we recognize 1/3 of that because again, this piece of plant is being depreciated on a straight line basis over 3 years. But of course, there's not a full year because we didn't acquire the piece of plant until the 1st of July x6, so we have to time apportion the income statement income. So again, this nets out at $12,000 being recognized in income to the income statement, which of course leaves an outstanding balance on the grant receivable of $36,000. Now the question now is, how are we going to split that outstanding balance between current and non-current liabilities? So we do this in relation to the useful economic life. So we know that in current liabilities for the following year is going to be another 1/3 because we're depreciating the plant over the useful economic life of 3 years. We're going to recognize 1/3 of the total grant receivable of 48 as a current liability at year end. And that leaves an outstanding balance of 20 because of course we have a total balance of 36. So if we're recognizing 16 as a current liability, the outstanding balancing figure of 20 is recognized as a non-current liability. So now we can go back and enter these numbers in our government grant schedule, and there we see the income statement income being recognized at 12, and of course we see the outstanding balances of 20 and 16 in non-current and current liabilities. So therefore, carried forward for the 31st of March to the 31st of March 20x7, firstly, in the income statement, we're recognizing a total expense in the year of 12 plus 7, which is 19. And also, we're recognizing a total outstanding balance in current liabilities of the 11, which we reclassified from previous activity, plus the additional 16, which of course is 27. And also, we're recognizing a non-current liability to government grants. We had an opening balance of 30. We reduced it by 11 when we reclassified 11 to current liabilities. However, we had to increase it again by 20 in relation to the grant receivable. So the net closing balance of non-current liabilities in relation to government grants of RC at the 31st of March x7 is 39. Thank you very much for watching this short tutorial from the Microlearning Institute.